Hey guys, welcome back to another video. So today in this video we're gonna talk about moving averages. Okay, we're gonna see what moving averages are and how they're calculated, and after that we're gonna go on the charts and see how you can use moving averages in order to predict the trends and the trend reversals. So without any further ado, let's get started. Please make sure to hit the subscribe button so that you won't miss any of the upcoming videos, and also please press the bell icon so that you will be the first one to notified whenever we upload new content. So without any further ado, let's get started. So the first thing is we need to define what are moving averages. Okay, so the moving averages are basically the average or the mean of the data points over a specific period of time. Okay, so let's say if we want to calculate a moving average of 20 days or 20 candles, what we would do is we would take the price, either the close price or the open price of those 20 candles, okay, and add them up and divide them by 20. That way we would get the moving average for one candle, okay, or one data point. So what we do in moving average is basically we take the data points from the past for a specific period of time and then calculate the mean. Now there are basically two types of moving averages. The first one is the simple moving average and the second one is the exponential moving average, and we're gonna go through both of them, so please pay close attention as we go along. Okay, so the simple moving average is basically it calculates the average of selected range of prices, usually closing prices. Okay, and it is a technical indicator that can aid in determining if an asset price will continue or if it will reverse a bull or bear trend. Okay, and the simple moving average is just simply the mean. Okay, so if I wanted to calculate a simple moving average as I described earlier, so if I want to calculate a simple moving average for this candle, what I will do is, if I want to calculate it for last 20 periods or last 20 candles, what I will do is I will take the close price of last 20 candles and add them up and divide that by 20, so that way I will get the data point for this candle. Okay, and it is basically the simplest moving average, but it has some disadvantages. Okay, it is slower and it gives the equal weight to all the candles in the data, okay, in the previous data, so which is not ideal for in some cases. Okay, it is good in some, but it is not ideal in most of the cases. So that's why mostly people use exponential moving averages. All kinds of, like, there are different kinds of people who use simple moving average and exponential moving average, and some people also use the combination of simple moving average and exponential moving average. Okay, so simple moving average gives equal weight to each data point in the past. Okay, and a simple moving average can be enhanced as an exponential moving average that is more heavily weighted on recent price action. So in exponential moving average, it emphasizes a greater weight and significance on the most recent data points. Okay, like all other moving averages, this technical indicator is also used to produce buy and sell signals based on the crossover divergence from the historical average. Okay, and traders often use the EMA lengths in different ways. Okay, they mostly use 10 days or 50 days or 21 days. So there are different time lengths that people use in exponential moving averages. So now let me show you how you can put the moving average indicator on the chart. Okay, so let me just remove these indicators from here, and here I am in trading view. So let me just remove these. And in order to put the moving average indicator, first we're going to go through the simple moving average, and then we're going to go through the exponential moving average. So let me put the simple moving average indicator here. So I'm going to write moving average, which is basically the simple moving average, and I'm going to put this on the chart. Okay, and here you can see that we get the settings of the moving average. So from here we can change the length of intervals we want to investigate. So I'm gonna put the 9, and I'm gonna change this thickness and also the color, okay, to green. So now you can see that this line basically indicates the 9 most recent candles average and gives a data point for the next one. Okay, now the reason for the using of moving averages is basically to remove the fluctuations or the cluster of data, because you see here the price movement, the close is here and then here, then here, so there's a lot of cluster or fluctuations in the price, because like in forex charts the volatility is very high. So that's why we use moving averages in order to remove those fluctuations. So if you look here, there is a smooth line, so it is basically used in order to determine the trend by using these smooth moving averages. Okay, and here you can see that this is basically a line for moving average, a simple moving average for most recent 9 candles. Now I'm gonna put another indicator that is simply the moving average, and I'm gonna give it a length of 21 and 50. Okay, so let me go here and do that. So let me change this to 21, and let me change its thickness and color, change this to blue, and okay, and I'm gonna change this to 50, and I'm gonna put this as a red and also change the thickness. So another thing you can notice here, as we increase the intervals of the candles or the number of candles, the price or the line moves away from the candles. Okay, and you can see that here that this is basically our line for 50 candles, this is our line for 21 candles, and this is our line for 9 candles. So the line for 9 candles is mostly along with the candles. Okay, and the line for 21 candles is a bit further away. Okay, and the line for 50 candles is a lot further away in here. Okay, and as you can see here, these are basically used in order to find the trend. Now let me explain how the simple moving average differentiates from exponential moving average. Okay, after that we're going to see how they're used in order for the detection of trends. So let me go ahead and put exponential moving average exponential. Now let me put that on the chart. Now let me change the parameters here to blue. Now let me keep this 9, and let me also change the thickness. So here you can see that the lines differ a bit. Okay, and you can see that the exponential moving average is responding more faster than the simple moving average. The reason for this is that the exponential moving average gives weighted average to the most recent candle. It gives most importance to the most recent candles. Okay, however, the simple moving average gives equal importance to all the data points or the candles in the previous data. So that's why you can see that exponential moving average is responding more quickly than the simple moving average. Okay, so moving averages are an important analytical tool used to identify the current price trends and the potential for change in an established trend. Okay, and the simplest use of SMA in technical analysis is using it quickly to identify if a currency is in uptrend or downtrend. Okay, and another popular but more complex analytical use is to compare the pairs of a simple moving average with each covering different time frames. So if a shorter time frame or if a shorter term simple moving average is above a larger moving average in an uptrend, an uptrend is expected. Okay, and on the other hand, if a long-term average is above the shorter term average, then the downtrend might be expected. So let me just show you what I just said by example, and let me just put another moving average. Okay, and here we can see that I'm gonna put this to 21, and I'm gonna change the color of this to blue. And so from here, as I said earlier, that if the smaller time frame moving average is below the larger time frame moving average, a downtrend is expected. As you can see here, that the moving average of 21 candles data points is above and moving average of 9 candles is below. So this is basically continuation of downtrend. Okay, and when we go towards an uptrend, as you can see here, the smaller moving average crosses over and goes above the larger moving average, larger time frame moving average. So the blue one is basically our 21 data points or 21 candles moving average, and the green one is the 9 candles moving average. So this is above, this green is above blue, which basically indicates that this is an uptrend going on. So this is how you can use moving averages to determine if there's an uptrend or downtrend in the market. But the thing is that this data is a bit laggy because it relies on the past data points. As you can see here, that the trend got reversed here, okay, but the crossover happened here. So this was because it is relying on the past data. So ideally we should have known that it is going to be reversed from here, but the crossover happened here, so that's why we got to know here that the downtrend is going to continue. Okay, so this is one of the disadvantages of using simple moving averages, and in order to eliminate these differences, traders basically use exponential moving averages. And let me just show how exponential moving averages can respond a bit quicker to the price changes or fluctuations than the simple moving average. Okay, so I'm gonna go ahead and change this to 21 and change the color to blue and also change the width, and here I'm gonna change this to green and also change the width. Okay, so now if I come here, you can see that the trend reversal started from here. Okay, there was a range, basically the range going on, and it just pulled up a little bit, but then the trend got reversed. Okay, so here you can see that it is responding a bit quicker to the price change because it relies on and gives more weight to the most previous data points. Okay, let me just show you another example that you can see that trend started to reverse from here. Okay, and here is the crossover happened, which basically indicates that downtrend is going to happen because this blue one is our 21 time frame moving average, and this one is basically our 9 candles time frame moving average. So this is below the larger one or the larger time frame, and this indicates that the downtrend is going to continue. In our next video, we're gonna see how you can use exponential moving averages as support and resistances, and how you can avoid the false fake outs, and how you can verify that these fake outs, because you can see here that the candles did open up above the 21 candles moving average. Okay, but again the trend continued, the downtrend continued. So we're gonna see how you can avoid these fake outs as well in our next video. I hope you liked this video. If you have any questions, please comment down below and I would love to answer them. And also please make sure to subscribe to our channel, and you can also visit our website www.forexb.co in order to learn more about forex and price action. See you guys in the next video. Thank you.